Okay, so I think we wanted to start today just having a conversation about fear and in the markets and what do we do with our fear and that sort of thing. So did you want to help us out with that, Chuck?
The biggest problem that we have in the marketplace is our emotions. And as I've said many times, when you make an emotional decision about your money, you're almost always wrong. And at times like this, the primary emotion that comes up is fear. And fear is a very primary emotion we have. It's an important emotion. And if you're stepping off the curb in the city and you see a cab coming and you jump back, it's a great time to have fear. But when the market's acting up the way that it's been doing, and you're hyper focused on business news and that type of thing, it's just very detrimental. Business news is great for entertainment, but it's not great for figuring out what to do with the market.
So should we watch less of it? What should we be watching?
I don't know. If you want to watch it for entertainment, go ahead. I mean, sometimes it's entertaining. I mean, you know what's really great? The market's going up, and all of the wise men on TV are saying, well, the market was undervalued, so of course it's going to go up. And then when the market's going down, the wise men are on TV talking about how they told you all the time that the market was going to go down. So it's entertainment. That's what it is.
Okay, so what should we do with our emotions?
Well, I mean, I think the most important thing is that when you develop your plan, your overall financial plan, not just your investments, but everything that has to do with your plan over a long term, that you set very strong timelines and what your goals and objectives are. And if those timelines and goals and objectives haven't changed, then it really shouldn't change a whole lot. That's basically it. Look and see what your allocation is and so forth.
Chuck, each time the market goes down, people say that this time it's different, but this time it is different. We have a global pandemic, and we had an extraordinary month in March. I mean, fear was justified. We had the second worst day in the 100-year history of the Dow. We had, extraordinary up days, extraordinary down days, extraordinary volatility, and so it is different with a global pandemic and the economy shut down. So how do you know that you shouldn't react, and how do you know that this time isn't different?
It is different. I totally agree with that. It's absolutely different. And 1987 was different. We had computerized trading, and all these sell orders were being triggered off by computer matrix and whatever their logarithms were. And it was very, very different at that time. And in the financial crisis of the last decade, that was very different. I mean, where have we seen, everybody always thought that real estate was going to go up and up and up and up and up. Like there was no way that real estate was ever going to go down, right? So that was a very different market. And likewise, this one is very different. They're all very different. But in the end, capitalism wins. That's the bottom line. In the end, capitalism wins.
So how should we act, or or shouldn't we react at all when something like this happens?
I think this is a great time to give your investment advisor a call and really evaluate whether or not what's happening changes anything in your overall financial plan. I mean, that's really what you have to do. And if it has, then you need to make some adjustments. For instance, something that may have occurred is with the stocks going down and the bonds coming up, it might be time to add to the equity portion of your portfolio because your percentage of equities may have gone below whatever your band is for whatever your financial plan is. But it should be based on your financial plan, not on what's happening from day to day.
Paul, what have you been hearing from people about their fear, and how does that affect what Chuck has been saying?
Well, fear and the flip side, greed, is a very personal thing. If you have a lot of money in the market, for example, and the market goes down 10%, you're going to have fear, as opposed to if you're not even in the market. I mean, what's there to lose? If you have something to lose, I'm hearing from people of a big nature, that's when fear is greatest. So Chuck, to you, yeah, you have crashes and this and that, but how do you suggest people manage their fears in context with how much they have in the actual market, which could trigger their fears?
Okay. Well, the first thing I want to say is that you're absolutely right. Fear is in all of us. Anybody that goes into it and says, oh, that's not going to affect me, that's not going to be a problem for me, they're not being very honest with themselves. Fear is something that affects all of us. And obviously, the more that you're involved in whatever the situation is, the greater that fear is going to be. So again, I mean, I hate to sound redundant, but I'm going to sound redundant, is that it all goes back to your financial plan. And in the very beginning, when you sort out all your policies on your financial plan, what you're doing is you're not setting policies for when the market's going with you. I mean, who needs a policy for that? You're making money. Who cares? You don't need a policy for that. Your policies, your investment policies, are exactly for the time when your fear takes over. That's exactly why we make a plan. We don't need a plan for when the market's going up. Am I wrong? I mean, does anybody disagree with that?
That sounds good, Chuck. Charlie, what about in sunny California? Has fear penetrated to the peninsula?
Yeah, you find people talking about this. It's the only thing they talk about. But in looking back about how this is different, the only difference is how it affects each individual. Some people aren't even that aware of it that much, but for the most part, it's on people's minds because everyone else is talking about it. But the way it affects people, is different for each individual. And they can either have the approach, it's something, new, unprecedented, but it's not really going to affect me that much. Others, take it really personally. And it depends on their own individual situation and what's going on in their lives. There are certain things where people get a lot more emotional. It could have to do with their family, what's going on, if they've had other hardship or tragedy, death in the family and stuff like that. Those people seem to get affected a lot more because they reflect on it more.
Yeah,
There's no question about that. Yeah. What, Tree?
I'm reminded of back in February, I think it was, possibly March, when there was more fear than we're experiencing right now. And you were giving some suggestions to people of what to do for with their fear, other than make investment decisions, which just sounded crazy, but it actually was very helpful. So do you want to talk about that for a few minutes?
Could you remind me what those were?
Yeah, it was don't sell stock, go for a walk.
Right,
I mean,
That's a good one.
right. I mean, people that know me personally know that when this whole COVID crisis started, I started training for the 5K, and that got me out, got my endorphins up. It really is a head game at this point. If you're sick or if you have a close family member that's sick, that's really a whole different set of circumstances. It's more than a head game. But for if you're healthy right now, then it really is a head game. It's all about keeping yourself mentally and physically healthy. But with regard to Charlie, what you were saying is, I think everybody, and this is one way that this crisis is very different than any that I've experienced in my lifetime. And that is that it does affect everybody, even if you're healthy. When I pull up to my local coffee shop to get my morning cup of coffee, and I have to put on my mask to go in, I'm scared. I have to be honest with you. I'm nervous. I'm thinking, should I really go in here? You know, should I touch the doorknobs? No, I better put on a pair of gloves. All of this goes on in our head. And anybody who's not experiencing that is probably living under a rock someplace. So that's something that affects all of us, which makes it all the more important that we have some kind of plan in place, not only for our financial life, but this is something that is extremely important, is that your financial life is really just part of your whole life. It's not a different thing. It's not like some other thing out there has your financial life. We have our financial life. So just like when we start out, for when things go wrong, we have to develop good habits. Okay. And that's the same thing here. We have to develop something that is healthy, that keeps our mind strong, and continue doing those things, even when we get nervous, especially when we get nervous.
Chuck, one of the things I always find difficult to understand, the economy can be in free fall, a global pandemic can be spreading, and the stock market can be bouncing back strongly. Those things can move in different directions. How do we square that? How do we keep those things straight?
First of all, it's very important to know that the market is bigger than we are. It's bigger than what we can think. And the market is the collective knowledge of everybody and every computer that is investing in it. And so at any given time, people are looking right out. They can't see past their nose. They're looking at what's really scary right now. And, if you notice that when the market went down, it went down really, really fast. And it's gone down faster and more than it's come up. And the reason for that is because fear is greater. Fear is greater. But then once people start to look beyond the pandemic, then they start to see other possibilities. They start to think about the fact that, we probably are going to get in an airplane again. I mean, the likelihood that I'll never be in an airplane again is pretty unlikely. I probably am going to want to go into a restaurant again. That's pretty likely. And so markets start to take a longer view. And the longer view is slower. So as the markets come back, they tend to come back slower. That's kind of the way that it goes.
Tree, you've been giving a lot of small business people advice. How are they dealing with the fear, and what have you been counseling them about?
They are adapting and pivoting and looking to figure out what works and how to make it work. You know, I just think that's innate to entrepreneurs. They all applied for the SBA loans. I don't think anyone I talked to received any of them. Um, and I should say they all, but really, I think there's about 3 that I've talked to who have either consciously made a decision to close their business, which were one of which was very new, and wasn't well established or well funded to begin with. But another one, I think, just because they couldn't figure out how to pivot, how to embrace online orders, how to decide that they're going to shift their normal product to a product. I'll give you a great example. So this person is a screen printer and embroidery type of person, right? And they just weren't able to see the opportunity in the 2020 high school graduates or college graduates really wanting more special, better things to be able to substitute for the graduation ceremony itself. So I'm watching other people sell all the same products and making a fortune that this other company essentially shut their doors on May 25th and just has, not looked back. But that's the minority. The majority are figuring out with their clients how to do the painting or construction work or whatever kind of work done in the house while the people are there. Have them go out for the day and go in and do their work, or how to make things happen online, and how to come up with a different product that speaks to the specific need. There's still a lot of needs out there that need to get met. They're just different, and they need to get connected. You need to connect with those people in a different way. For the most part, the small businesses that I'm talking to are accomplishing that.
Charlie, you were dealing with somebody who was letting fear get the most of his investment decisions. And what kind of impact is that having on his life? And what kind of advice were you giving him?
Well, I was giving him, I was reminding him of, he ended up taking money out of the market. And during that time, he was just panic stricken, and he didn't know, what to do. So what ended up happening is he just ended up rationalizing to himself that, if I take money out of the market, then I won't have this. That'll make my panic go away. But that wasn't the case. He kept on second guessing himself, and so it was a really torturous situation with him, because soon after most of the market declined, he took that action, and then during that for the next month, he sees the market coming back, and so he was just it was a terrible situation for him. I had to remind him of all of the good decisions he's made in the past, and so that with that he was able to overlook this one, get back in the market, and then go on. And so it was just a situation where he just felt like he needed to do something. He didn't know what it was. So in taking that action, it ended up not having the best financial results, but in his mind, the thought that he needed to do something to make things go away was what he chose to do. I, kept reminding him that that's the goal. What your financial advisor is there to do is to help you through these situations, and you have to listen to what that person has to say. Even during that time, I'm telling him that that wasn't, the best action to take, he wasn't really listening to me, and he was just focused on what was going to help him get through this, even though it wasn't the most rational thing to do.
Larry, do you?
Charlie, I'd like to address something that you brought up, and that is that he felt like he had to do something.
Mm.
And that is something we all experience. When something tumultuous is happening, we feel like we've got to do something. We just have that feeling, right? And again, the something is to look back and see what you have planned and all the things that I've already mentioned. But that feeling is there. The other thing about that is to remember again that during times like this, there's other needs that need to be addressed. Teresa was just talking about, if you happen to be a small business person, or you've got your eye on this fear over here about what's happening in the marketplace, you're not looking at the opportunities that are opening up for your business at the same time. Another thing that has happened during this particular crisis is that people are home. And when you're home, you have time to do things with your family that you've never been able to do. How many people have said, if I only had time to do such and such, I would do it. And this is the time to do that. And again, it goes back to the idea that our finances are not separate and apart from us. They're a part of our life. And just because something is going by that catches our attention doesn't mean that's where we should focus our attention. Sometimes it's a distraction from the rest of our life, which we need to pay attention to.
And part of that, in explaining to, this person or our clients in general, is the fact that, you do have a plan in place. Your portfolio is designed with a lot of looking at the future, and our clients are in a good situation because of the measures that we and they have taken in order to provide stability, and just something that will get through a situation like this. And they have to be reminded of that. They've worked hard, and they've got to this point where a lot of people are financially independent, and they have to be reminded of that and not panic when something like this occurs, or everyone else says that they should be panicking.
So there's two parts of what you said that I'd like to address. One is in the financial plan itself. One of the things that we have as part of that plan is liquidity. So that's why we have liquidity. We have liquidity for exactly times like this. So if it's needed, it's needed so that the money's there. The second thing is, again, not to be redundant, but you were talking about the portfolio. And I think it's really important as investment advisors and people in general that at times like this, we not overemphasize the portfolio, and to say, again, what's the portfolio of your life that I need to be paying attention to? We've addressed that. We've got a plan in place. We've called our investment advisor. We've evaluated whether or not this thing that's happening demands a change on our part on the basis of the plan that we have in place. And if it does, then we make those changes. If it doesn't, we don't make those changes, and we move on and focus on other important things in our life. And frankly, we have a lot of very important things in our life.
So Larry, you've been, Lexington's been around for over 15 years. And one of the things that Charlie said that his client experienced is he had a very strong emotion. He took a serious action thinking it would relieve the strong emotion, and it didn't. And then he was still left with having to wrestle with now a myriad more emotions. Have you seen that in your Lexington experience, that people take action thinking it's going to relieve an emotion and actually things just escalate?
Yes, I find that a handful of times, you know, in the Great Recession, 2007 to 2009, and the more recent recession or market collapse, I've seen people dump their stocks, and invariably they regret it. It's hard. It's almost un-American to do what Chuck says and not take action, but it's usually the right course. And if you do what Chuck was saying, stick with your plan. It can feel uncomfortable for a while. I mean, even a year or two, but the rewards for sticking with that plan, you know, over 5 to 10 years are tremendous. And if you're investing for a much shorter time, you shouldn't be in the stock market anyway. And if you have a diversified portfolio, um, it's going to come back when the economy and the world economy come back. So it's a matter of sticking with it, having confidence and faith in the global economy, not in your ability to predict the future. I mean, I've seen in my own case, time after time, it's impossible to predict what's going to happen. I mean, you know, if we look back. It was only March 11th that the NBA canceled their season. So about 2 months ago, this whole market collapse, economic collapse, spread of the virus in the U.S. has happened in an extremely short time. And I don't think anybody was able to predict that.
Can I interrupt for a second? There is a person I know who very much wants to predict the future. And what she does is she employs psychics. And with the market, she actually has these psychics, well, she's using one in particular, who advises her on when to sell Apple. You know, and the psychic has absolutely no background in finance, but just a feeling. And what this person does is, in a way, she's to conquer her fear, she has psychics. And then it also is a mechanism for her to assign blame. If the psychic is wrong, she just hires another psychic. So I want to get to Chuck on the notion of fear, and that there are people out there that try to distance themselves from that emotion by having someone else to blame. So can you talk about this? I realize this is out there, but you know, there are people like that.
So let me address that, Paul. And I think, you know, turning to a psychic is extreme, but it points out that it's really difficult to predict the future. And I've never had any luck at it. And if you look at the market reactions, for example, in March, in a 3-day period, the Dow was up 17%. That was the fastest up move in the Dow since 1931. And the idea that anybody could predict that over the next 3 days, the Dow was going to do the best it's done in 100 years, it's pretty tough to predict. And once you had that 17% move, I mean, that was there for all time. That was money that was made that wasn't available to make another time. You know, that 3-day period was the equivalent of a year and a half of normal stock market returns. And trying to predict the future, mostly deprives you of those kind of moves.
I think that people need to realize that, what we've set up for them is working for them. And in order for that to work efficiently, they just have to leave things alone and be aware of that, what we've set up for them is working for them. And that way they'll capture those big up days that add to a significant portion of their overall portfolio.
So what this reminds me of is being able to discern and then accept the things that are in your control and not in your control. So like Paul, that example that you were saying, she recognizes that what happens in the market is not in her control. And so the way she's going to deal with that lack of control is to get somebody else to, hold on, let me just get Chucky back on the screen here. Hey, Chucky, you're back. Chucky, can you hear us? Can you hear us? Okay. Well, he's
Give
gonna
him some sign language.
Can you hear me?
Yes.
Yes.
Now.
Yes.
Yeah, that's great. So that's how she deals with not being in control. But the way I relate to what we've been talking about having a strong fear or other emotion and wanting to take action from it is when Zoe has a sniffle or a sore throat, right? Before COVID, right? My immediate, without even thinking, right? My immediate thing is to jump up, run to the kitchen and start making chicken soup and boiling a pot of steam and grabbing the vitamin C and saying words like liquids, here's 3 tissue boxes. It's to take action to stop or cure or prevent or solve the problem that I've sensed. It's an immediate visceral thing. So I think that's what we all want to do when we have fear about the market or when the market's feeling fearful, is we're innately wired to take action to stop that thing from happening or to protect ourselves or both. And we can't do either. And it really takes a lot to talk ourselves off the ledge and remind ourselves, this isn't in your control. But what's happening in the market isn't in your control. What is in your control is the decisions you can make about it, meaning your money, right? And if my decision is simply, okay, I shouldn't make any changes to my investment, it feels like inaction, which is why I think Chuck's advice of going for a walk resonated with me so much, because if I can't make chicken soup to cure the problem, I need to sure as heck be doing something else with myself, because just the intellectual decision of not selling everything doesn't satisfy that need. So I need something else in order to, and it comes back to, the knowing what's, accepting that that's not in my control and moving on to what is. And I think that's 5K comes in, right?
Chuck, I like that idea of, personally, I like the idea of taking a walk, but what other advice do you have for people other than taking a walk to control that desire to do something?
I'd like to address something else. We were talking about how if you sell out of the market, it doesn't solve the problem of the panic you're having.
Mm-hmm.
It just creates more panic.
Mm-hmm.
And that's the reason for that is really very simple, because, okay, now you've made one decision totally on emotion. You got your money sitting there in cash.
Mm-hmm.
Now you have another decision to make. When are you going to get back in?
Right.
And the odds of being right about when you're going to get back in, when you've made an emotional decision to get out, left to your own devices without any clear guidance, chances are you're going to use an emotional decision to get back in. And that's that. So Larry, going back to what you were saying about what are some other things to do to deal with the fear emotions. Again, I want to say that our money is only one part of our life. Enjoy our family. The other thing is, me personally, I use meditation, mindfulness. Sometimes if I'm not practicing for the 5K, I'll actually do a meditation walk. There are a lot of things like that, things that you enjoy doing. I love to read. I am enjoying reading a lot more right now. If you like to paint, whatever hobbies that you've put in the closet and you haven't done in a long time, take them out of the closet and do those things. These are the things that we do to become richer. Yes, richer. We become richer by developing our whole life, not just our money.
Can I go back? That's great. I want to go back though to the notion of a plan, because when you say plans to people, it can sound a little boring, frankly. You have a plan. For example, let me just make it, on the Titanic, you boarded the Titanic. There was a plan on the Titanic. If something happens to the ship, we have lifeboats. Not to worry, folks. And clearly, certain people were allowed on the lifeboats and others were not. So that particular plan didn't materialize the way maybe it was intended. So when you set up a plan as a financial advisor, how do you assure a prospective investor in advance that that plan is a good one if it hasn't really been tested? How do you show them over time the testing of the plan and that it's working?
Okay, first of all, let's address one thing that you said. You used the word that should never be used with money or with life at all. And that's the word assure. We can't assure anybody of anything. I can't assure you that when I walk out to my car, I'm not going to get hit. Nobody can assure anybody about anything ever. The purpose of a plan is to develop to the best degree possible risk mitigation on the one hand and growth on the other. And that's what the goal is. And the way that we do that is by establishing, what you need in the terms of liquidity and so on and so forth. But by no means is anything ever guaranteed about anything. And if we don't understand that about life, then there's something to learn there.
All right, I'd like you to you've used terms like risk mitigation, liquidity, and growth that only a more sophisticated investor might understand.
In other words, we try to...
I'd like you to put it in terms that the common person can well understand.
Okay, so what we want to do when we're putting the portfolio together is to address the needs. If we go into a situation such as we have now, that you have money to spend if you need it. That's the first thing, that you have money to buy food and that type of thing. That's one thing. And that's by looking at all of your resources that you have available. And the term growth kind of speaks for itself. In good times, we're looking to have a portfolio that participates in the upside. In other words, that goes up when the market goes up. It's also about balancing the plan. For instance, in the 2000s, from 2000 to 2010, if you had a portfolio that was in the Fortune 500, you broke even. That was it. Your money sat there, it didn't do anything. But if you had a portfolio that was invested in large domestic stocks, and you had portfolios that were invested in emerging markets, then you had positive growth. It's all about diversity. The same thing from 2000 until when the market took their hit at the beginning of the pandemic, the emerging markets didn't do anything. They weren't doing well. And that was made up for by the fact that our market was doing well. If you look at any given time, nobody can tell you what market's going to do well and what market's not. There may be ways that they can think that they know, but we really don't know. I mean, I remember a time when bacon was the most, like you just didn't eat bacon. It's very bad for you. Bad to eat bacon. Then all of a sudden bacon got popular. And guess what? Pork bellies that year were a top performing commodity. Who the heck would have ever thought that bacon was going to be healthy? Okay, so you can't predict these things. You can only plan for them, and that by planning for them is what we call risk mitigation.
So, Chuck and Paul, one way I try and deal with risk and put it into concrete terms is I tell people I can't predict when and how deep a bear market's going to be, but you should assume that there will be bear markets, and I assume that once every decade or twice every decade the market will go down 50%. So what that means is if you have $100,000 in the stock market, at least briefly, you'll lose half of that, 50,000 of the 100,000, and you have to be prepared to ride that out. You can. Any money you have in the stock market, you have to be prepared to have for the long term. And the reason you deal with that risk is what Chuck was talking about with the growth. And on average, the US large cap stocks, the Dow, has gone up 10% a year on average for 100 years, sometimes down 50, sometimes up 20 or 30, but on average up 10%. So that means every 7 years your money doubles. So there's a big reward for absorbing that risk, but you have to be prepared to accept that risk and stick with it and be around for the long term. So that's how to make that risk mitigation seem concrete.
Right. So then I think you should address people at different points of their life cycle. Some people can't wait 7 years if they're 70 years old or something like that. How do you deal with clients versus a 22-year-old? How do you deal with clients on that spectrum?
So sure. So if somebody's 70 years old, they shouldn't have 100% of their money in the stock market, right? So they should only have maybe half of their money in the stock market, maybe less than half. And whatever money they do have in the market, they have to be prepared to leave in there for 5 or 10 years. So even somebody who's 70 might have a life expectancy or with a spouse, a life expectancy of 20 or 25 years. So for some portion of their money, they do have time for that money to come back. And, if you look at the crash of 87, your money got decimated for a couple of months, but within 9 or 10 years, those dollars that were in the market, even before the crash, were worth $5. So the reward for for sticking in the market through the crash of '87 was significant. But you have to decide how much money you can risk in the stock market.
Now, on the
There's
flip
another
side of it,
aspect to that too,
Right.
which is that even if you're older, depending upon how much money you have, period, and how much you're spending, you may not be investing just for your lifetime. You may have as part of your financial plan who or what organizations are going to get your wealth after you pass. So if you happen to be in that situation, then even if you're older, your time frame is still much longer. So each plan has got to be developed for the individual, which is why we say when things get rough like this, that's where you go back to the plan that you have and stick with the plan. And the plan should be consistent with your age, your risk tolerance, the whole ball of wax.
let's go back to, though, an issue of timing. I mean, if things are going really well in the market for like this last 10 years up to this crisis we're having, would it not be prudent to, part of the plan is saying to an investor, maybe you should start harvesting some of your gains?
So here's I'd like to answer that, Paul. That would be very wise in 2020 hindsight. Like that would be brilliant in 2020 hindsight. But we don't have 2020 hindsight. So would it have been really wise to do that in 2014? The market had done really well then. How about 2015? It had done really well then. How about 2016? It had done really well then. How about 17? It had done really well then. That's the point. When you come out of the market, you still have to make a decision about when you're going to get back in. And that's why you look at an evidence-based approach to investing over a period of time that has to do with your particular plan and develop your portfolio accordingly.
Chuck, great answer, but let me add to that. So when we set somebody up with an asset allocation, say we're going to have 50 or 60% of their investable assets in the stock market, and we say say we're using 50%, and say there's been a good period in the stock market and that gets up to 60%. We're not making a judgment about the stock market per se, but we're saying they now have a higher percentage than was in the plan, so we'll trim that. And conversely, if the market goes down a lot and they were planning to have 50% in the stock market and now they have 40%, we'll add to the stock market. So that's a way of doing what you're suggesting, but in an evidence-based way where you're actually looking at what the purpose of the money is for. So if somebody accumulates all the money that they need, they don't need to take as much risk and they can adjust their plan. But otherwise, we do it through this mechanism of the asset allocation.
Gotcha. Thank you.
All right. Does anybody else have any more follow-up questions or thoughts on this topic?
Chuck, maybe you could give us a summary.
Yeah, kind of. So here's what I feel has come out of this is, first of all, when we talk about making a plan, we take into account what's going to happen when we don't know what's going to happen. When things are going the way we don't want them to go. That's why we're making a plan. And the important thing about that is that doesn't just include our money. It includes every part of our life. And so it's very important to have a plan for, where do you want your family to be 5 years from now? Where do you want your family to be 10 years from now? What do you want your health to be 5 years from now? I want to be able to see my youngest daughter get married. I want to be able to do things. So I want to be able to take care of myself. I want to be able to enrich myself mentally, so I engage in my hobbies. I want to be able to be calm on a day-to-day basis. So that's where I practice mindfulness. And all of that is exactly the same as establishing a portfolio over time. And of course, we are not going to be able to avoid fear. It's not going to happen. We have to plan for when we have fear. That's why we plan. And that's pretty much what I feel came out of today.
Great.
Good.
I think, Larry, in one of your recent articles, you had these two sentences. We don't need to sugarcoat the situation, but we can help just reaching out and helping people clarify their goals. Most people understand their own situation, but don't necessarily act on their own or push themselves to see clearly. And, that's what we can do, to be around and be helpful and let them see clearly.
Wonderful. All right. Thanks. This is great.
I think if you want to sum it up even shorter, I like Chuck's phrase, don't sell stock, take a walk.
All right. Thanks, everyone.